Episode number 8, institutional sponsorship. Okay, one of the foundations to our trading. Okay, institutional sponsorship is the foundation to every trade idea. Think of it as a fixed checklist for every trade, because that's essentially how we're going to use it, right? So what is an institutionally sponsored move? We have to have the opening price as a reference, right? Selling above, buying below, a high time frame key level, inducement for the high time frame key level. So if it's a bullish key level, we want to see a short-term low just above it or around it. And if we're bearish, we want to see a short-term high just below it or around it, right? We want to see SMT, displacement away from the key level, fair value gap, and a change in the state of delivery, the order block confirmation, or an IFVG getting confirmed, right? Once we have checked off all 6 points, we can assume that the move is a sponsored move and should hold until the opposing drawn liquidity. This is fractal and should be considered on all time frames. Okay, so here's an example of what a complete institutionally sponsored move would look like. We're bearish, we have a high time frame premium key level, right? It's only a key level if it's in premium. We have stops just below the high time frame key level. We then have SMT. We then get displacement with the fair value gap, a change in the state of delivery, and this run above the high is above the opening price. Right here would be an institutionally sponsored move, right? Bullish example. Discount key level, low just above the discount key level. Then we get SMT, a change in the state of delivery, displacement, and all of this run below manipulation going below the opening price, right? This would be an institutionally sponsored entry right here. Okay, let's have a look at this here. Okay, so the framework for this trade is we've gone above the buy side liquidity here. We're obviously expanding lower. We've got relative equal lows here, and we have a daily FVG that we can frame a trade off of to run out these relative equal lows, right? So this is a high time frame key level, right? So we're going off of it, like I said at the beginning. Think of it as a fixed checklist. So do we have a high time frame key level? Yes, daily fair value gap. Opening price, do we go above the opening price? Yes. Inducement for the high time frame key level, right? So around the high time frame key level when bearish, just below the key level or within it, right? We have a short-term high, right? We want to see that get run out for buy stops. And then we want to see SMT. So you can see YM is making a higher high here, and Q is making a lower high, right? So we've checked off 4 of those points. We then have a change in the state of delivery, which occurs. It's the collection of up-closed candles that trade into the liquidity, the buy stops, right? When we close below the bodies, it doesn't have to be the wick. When we close below the bodies of the lowest up-closed candles when bearish, that is a change in the state of delivery. And then do we form a displacement? Yes, we do, a fair value gap here. So as soon as this candle closes here, and now a fair value gap is here, we have everything for an institutionally sponsored move. This is an extremely high probability trade now because we've checked off all 6 of these points. Market trades into the fair value gap and then absolutely melts to relative equal lows. As we mentioned, is a high probability drawn liquidity, and every A+ setup has them.